Good morning, everyone. This is John Blank, and it's Monday, July the 17th, 2023. And I am the Chief Equity Strategist and Economist at Zacks Investment Research. I've been doing these quite twice a month for some time now, and they're typically about investing issues or economic issues. I've been focusing for months now about the investing issues, and I haven't really turned my attention to economic issues. But it is the mid-year. So I am going to give you what I will term breaking down the big mid-year 2023 recession debate. And that debate is between the bears, who see leading economic indicators being negative for 15 months, and the bulls, who see coincident economic indicators at record highs. So who's right, who's wrong? The answer, of course, is both see something important, and we need to understand what they see and why they see it. And then I will give you my diagnosis as an economist, what I think is the benchmark, the base case for what's going on. But keep in mind here, the future is always uncertain, and there is no path that's certain. And that's the main point of listening to both the bears and the bulls, because in all kinds of scenarios that no one can see, both are going to be right. So part one, leading indicators. We will go through the leading indicators, what they actually are. Part of the problem with the leading economic indicators as the buyers use them is they don't study the interior of what the actual indicators are, why they are called leading indicators. Part two, coincident indicators. Coincident means at this moment in time, currently, not calling the future, just actually appraising the situation you're in now. I often find the better route for people who want to stay connected to the market and the economy and do better is just to simply live in the present, folks. Live in the present. Live in the present means clean out your attic upstairs, clean your mental attic out, see where you are in time, and stay on top of it and update it. That's the coincident indicator path. It's a humble path, but it's a very powerful one. Part three, I'll finish with my conclusions, and frankly, a few conclusions that are not mine. But all in all, this is the strategy to give you a better understanding of this incredibly important debate. So once again, these are the views of me, John Blank. I have a PhD, and they are not necessarily the views of Zacks Investment Research. Read this later at your leisure. Like I said, leading indicators. We're going to get there first, and we're going to stay here for a while. Number one, the Conference Board leading indicator index components. I want to point out there are two sets of components. Three financial components, 30% financial, and 7 non-financial components. Now, they don't give us the weighting of which to which, but let's assume it's 30%, 70%. 30% financial, 70% non-financial. That could be completely wrong. So first thing is, you're going to build a leading economic indicators. You're not going to tell us how you're going to weight this. But in general, people do like the financial components, and they do list them front. So it may well be the case these are the dominant components, and they get more weight. So the leading credit index, that's theirs. They're trademarking it. So what would this be? This would be credit spreads. So, tight credit spreads, lots of credit, high interest rates on mortgages, not so much credit. There's probably a whole bunch of credit indexes that are indicating tightness or weakness. So why does credit matter? Because you can't finance something in the future you won't be able to spend and do the activity you want to finance. So that would be in a leading indicator index. The S&P 500 index of stock prices is a leading indicator. Why is that? Because traders are betting on the future earnings path of companies, and they do that through picking sides in the stock price debate. So stock prices end up being a leading indicator because they're indicating where the earnings are going to be 6, 12, 18 months from now. Number three, critical one. You hear a lot about this one. I think this is probably the dominant hat to hang on here, the thread to hang on for understanding this debate. It's the interest rate spread between 10-year Treasury bonds and the Fed funds rate. Sometimes it's the 2-year rate, but typically it's the 3-month or 1-month Fed funds rate. So that spread, when it inverts, it has typically always been accurate to forecast a recession. but anywhere from 1 year to 2 to 3 years out. So it's not very accurate in time. Timing is horrendous. And frankly, it's also for recessions that we've seen through cycles and not what quickly happened, which is getting out of a pandemic first time in a century. So we haven't really seen this event before, and there's a lot of worry that that is more noise than signal this time around. Non-financial components. Average consumer expectations for business conditions. So expectations are for the future. So there are measures of the consumer's expectations for the future of business conditions. The ISM, the Institute of Supply Management Index of New Orders. If someone's not ordering something now from a manufacturer, they're not going to get it in the future, which will be less output for the future. Building permits, not actual sales or construction, but the permits to build. So again, a future indication of future activity. I'm sorry, a current indication of future activity. Average weekly hours in manufacturing. If manufacturers are not giving people a lot of time in the plants, we can assume that it's because they don't have the orders. Manufacturers' new orders, non-defense capital goods, excluding aircraft. Very interesting language here. New orders, again, of course, but this is non-defense capital goods, so it's investment goods. So what's going on here? If manufacturers are not getting orders for investment capital goods, people are not betting the future is going to have need for more capacity, so they stop investing. That would be a concern, and it would be a leading indicator. Manufacturers' new orders, consumer goods and materials. So this is, again, probably a sub-index of the new orders. Both of these are probably the sub-index of the other one. This is about consumer goods. So if consumers are also not coming to the plate and materials are not being bought down the intermediate path, it would be another leading indicator. Weekly initial claims for unemployment insurance. This is also one to track. And when it rises, it can foresee a future weakness because people are firing people because they're not making money in their businesses. So there we have it. Those are the leading indicators. Stop, take a breath, and remind yourself to come back to this slide because this is going to be telling you more about what's going on. And we're going to look at each of these, or at least 8 of these, in a short period of time. All right, there they are. Conference Board leading macroeconomic indicators, 3 financial and 1 non-financial. So here is money supply. So leading indicator. So the money supply, M2, has been going up quite dramatically. We index this to 2010 being 100. And as you can see, super liquid market from 2010 that we've got 2.5 times the liquidity here, but it has rolled over for the last 6 months. Have we seen this before? Actually, we haven't. So slightly bearish, but I would keep in mind here 2.5 times the liquidity from 13 years ago is still quite bullish. Down here, S&P 500 return. Again, the bears look great for this period of time up until basically October of last year. Last 8 months, they've been dead wrong. And look at this. This is a very smooth path up with an overdone play here, but by and large, this is very bearish, or bullish, I'm sorry. So this, again, is probably replicating this kind of back to trend. And this is certainly over on trend bullish. So we're still looking for something that's truly bearish. And like I told you, here's the interest rate spread. And yes, we've had this go down dramatically as the Fed raised rates. This is certainly negative, and it's certainly causing the concern. It is the Treasury rate spread of 10 years minus the 3-year constant maturity rate. So you can see this is typically at 85. Now we're down to minus 40. That's a big change. And any indicator will see this drive a lot of the top line performance. Now, building permits. This is also interesting. Building permits are back on trend after a big surge. So here we've got a big M2 surge, we've got a big stock surge, and we've got a big building permit surge. But we also have a return to a longer trend. So in these 2 instances, stock prices and building permits, we have returned to trend after a COVID bubble. In liquidity terms, we're still not there yet, but we're still above trend and getting there. And this is the interest rate spread. This is what the Fed is doing. And that is where the bearishness gets picked up. It's by the Fed's decision making. Keep this in mind. Come back to the slide. Again, I put leading and leading here and leading here. And that obviously is leading, but it's non-financial. Okay. Or more non-financial ones. Average weekly hours. Of course, big drop during the COVID pandemic. And they are going down. They are going down. Slightly softly bearish. I would just point out that they're holding up at this level here. It may just be because we had too much demand for a while. Now we're getting back to some lesser number. Okay, down here, little rise actually in unemployment claims lately, but still very low. And typically there is ebbs and flows in the market. It always needs to be understood that there are recessions and expansions and recessions. So there certainly has been a recession in the current expansion, has been a recession in tech jobs at the major firms, which we would have expected. Over here, this is your new orders consumer goods. So extremely strong. 150, but not 160. So definitely rolling over the last few months, but at a high level. And again, not within the range of worry. This is another place that it rolled over. And there's plenty of times where you can imagine here that have stayed sideways for a while. So it's entirely possible more in a period like this than anything else. And we're, by the way, still extremely high number of new orders for consumer goods. Here's not capital goods. This is actually bullish and hitting a record high. What else needs to be said? If there's a recession, why would capital goods be at a record high? Look at that. It's a record high. That is not even slowing down at all. Fascinating to keep this in mind. That actually is very bullish on the future. Okay. So I'm going to throw a few others out there. That two other looks at share prices. Of course, the S&P 500 is the conference board share prices, but growth ETFs, and over here the ARK ETFs and the mega cap stocks can be used as leading indicators. Why is this? Because they are parts of the S&P 500 here. This is basically 25% of the S&P 500. And over here, this is people's outlook for growth. And again, you're seeing that same pattern here that you saw before. There was a COVID bubble. However, even in the ARK innovation in ETFs, you do see things grinding north 7-8 months from now. They're still no higher than they used to be in 2019, but they are no longer going down. That needs to be kept in mind. That is consistent with the story we're telling, but this is probably even more consistent. Let's look at all the different lines, and they all somewhere in late 2022 when the interest or when the consumer price inflation numbers started to roll over, all the big mega cap stocks, all of them, and I'm using that correctly. Look, 1, 2, 3, 4, 5, 6, all the ones I'm showing you here. And I can put Tesla up and be another one of these bubble ones over here. But the basic point is people are buying the big tech stocks, and they're buying them since the inflation rate turned around. That is actually the story that we need to keep consistent of, because that's telling us something interesting, that the inflation rate, not the cycle, was the problem. And that is the supply shock to the economy that came out of COVID. That is a different thing than we've seen in the last century. It is different. All right, the housing market can be used as a leading indicator. All right, so let's take a look at it. Home sales did go down, but on trend over time, they're pretty high. Sales prices have come down, but they were very high. One would expect prices to come down after doing record highs during COVID. Houses for sale month supply now are down to 6. It was getting high, now it's no longer high. People are stepping up. There is innovation in the market to keep people in. That's surprise. And the surprise news here is we're back down to this level. In general, when you get into the 10-month supply of inventories for houses, you do get a recession. We're over that, but now we're down below that. So somewhat high on trend, but still way below that. Certainly not this year for a recession from this variable. Privately owned housing units, this is what we saw with the permits. Yes, there was some uptick there, but now we're back on a trend that's growing and high. So I would say, do we have any indication of recession? Only here at the sales price level. That would be the only one. 3 of 4 are bullish. All right, coincident indicators. Like I said, here's a place where we're just going to clear our heads up to understand more about what's going on. What coincident means? This is Merriam-Webster dictionary. It's of a similar nature, harmonious, a theory coincident with the facts, occupying the same space or time. So it's the same space or time. These indicators are occupying the same space or time. And they're all labor market indicators. This is critical. Coincident indicators are job market indicators. Non-farm payroll employment is the key. Household employment is lagging, but still considered. Average hours worked in manufacturing, and of course, wages and salaries. Hours and wages will make up what people take home in income. This is the overall level of activity, either from the business perspective or the household perspective. So critical to look at these. Keep this in mind. These are the Fed ones, Federal Reserve Economic Database is the St. Louis Fed data. This is not the conference reports. Okay, so here we go. Not necessarily the Fed ones. These are the conference board ones. So here we've got all employees, total non-farm payroll, strong. Real manufacturing and trade sales, strong. Industrial production, strong. And real personal income, excluding transfer receipts, record highs. So here's a record high, there's a record high, there's a record high, and this is very high. So the combination of these would be, as Ed Yardeni would tell you, or I would tell you, or anybody would tell you, any indicator series using these 3 components is going to be at a record high. So the labor market's hot. I'm not telling you anything you didn't know. I'm just showing you new charts to track it. And you can look at this yourself. There's some indication that things are getting, high levels of slowdown and growth, but they're still very high levels. And you would expect this topping action to go on. For example, here it's gone on for quite some time. Why should it go down right away? No question that that's a little premature at best. All right, 3 more coincident indicators. These are the ones I put out in my economic summary. This is job openings. 10 million job openings. There used to be 7 million, so 30% above. Yeah, of course, they've come down, but still quite high. Quits, people looking for better jobs. 4 million of those used to be 3.5 million, so still quite high. Coming down, of course, but of course, that's what the Fed wants. Fed is doing this. That's the Treasury yield curve inversion. Of course, that's going to do this. And unemployment rate. Look at this. Really, all we're doing is we're coming back onto the trend from 2019 pre-COVID. Unemployment rate is certainly strong. And again, all we're seeing here is strength in the labor market. All right, stock market balance sheets out there and what to do with the 2024 election. Okay, so there are some bearish issues here. There's a bear issue. We're talking about stock markets, but generally speaking, 52%, or I'm sorry, 32% goes to 1% of the population out there. Just keep that in mind, people who are super wealthy live on passive income, and passive income is called correctly passive income. It does not create activity. It's passive income. Very little activity from this. This is actually bearish. And then the presidential election out there. Keep in mind that this is always going to be a period where the incumbent party wants to have a good economy. That would be one for the bulls, because I cannot see the existing incumbent party not wanting a strong economy next year. That's a leading indicator. The 2024 election would be a bullish indicator. So score 1 for the bears on inequality in the stock market. Score 1 for the bulls on the coming presidential election. All right, my conclusions. Let's get through this as a final. All right, this is Constance Hunter. She works at AIG now. She should be a chief economist at KPMG. Really smart person and great to listen to. And she took and put together a tweet over the weekend that really summarizes the situation. Is the inverted yield curve signal or noise? Signal red, meaning bearish, or noise, bullish, given the pandemic's unusual impact on data and rolling sector recessions we are already working through. So this is the case. The pandemic's unusual impact on the data It's a supply shock, and the rolling sector recessions we are already working through. That is the story of a supply shock situation, not a demand shock. She's telling you what I already told you, that a lot of people are putting their yield curve and they're saying it's signal. The rest of us are telling you it's noise. So here's my thought-provoking macro up here. So one is, of course, the leading economic indicators do indeed lead to an epic demand collapse, and there is a U.S. recession, but it's a year from now or 2 years from now. Keep in mind, this is still on the table. There can be and will be a very serious one. Getting 24 months of declines in leading indicators would be serious. So that would be another year of super serious LEIs. Keep this in mind, we're at 15 months now. We got another 9 months of that being next summer. Still cranking away. Get to that period where we're cranking LEIs to the negative point next summer, we're going to have trouble. The other is that we're just unwinding this supply shock. The Fed will cut rates next year, and this will not happen. That's the bet the market's making. And that ends this whole story, and it reshapes the narrative in a totally different way. So it's really, here, it's going to be the Fed Treasury yield curve version, which is effective with the Fed. Here also, it's also the Fed. It's kind of what the Fed does, right? So either we get a huge downturn because we're going to do 2 years of declines and super tight rates, or we're just going to get out of the supply shock. The S&P at 4,500 in midsummer is forecasting that this is a once-in-a-century global supply shock. All right, how to frame the bear-bull debate. The giant discrepancy between leading and coincident indicators. Leading indicators typically call recessions, and stocks are turning up. There's no recession in hand. One thought-provoking auction. This is going to get much worse before better. That's what I already laid out. The other is fiscal policy, infrastructure, and is overriding the Fed funds rate hiking. This president has to stand in an election, like I said, and there's a rider in the infrastructure package that's already passed. It requires all the spending to end at the end of 2023. January 2023 is the election in November. So 7 weeks later, all the spending has to be done. That is brilliant. It is brilliant because you got a Fed funds rate hiking cycle in hand, and he's simulating the labor market through the infrastructure package to keep the jobs flowing through next year. All right, what did drive the stock price rally? You know, Bob Elliott's really a smart guy. He's had an investment bank, the largest hedge fund in the world. And he made a great point. The rally across asset prices was, in the last week, was pretty much driven by the shifts in the discount rate, which is basically the future Fed's fund rate. There's already 6 Fed funds rate priced in and expected for 2024. That's 150 basis points plus from 5.25. So that the market is expecting us all the way back down to 4% or even lower in the Fed fund rate by the end of 2024. Getting further on stocks by at this point, by the way, means getting more priced in. That may be a big over thing. And by the way, if you go to 4+ and not 6, the market tanks a bit. So we're in a place where the market's gotten very belief driven about the future of lots of Fed fund rate cuts. And they're driving the discount rate. Discounted present value of stocks goes up when the rate cuts outlooks go up. That's basically what's going on here. Keep that in mind. It's really priced in. All right, the Deus ex machina. Like I said, this entire story is about the Fed. And the Deus ex machina is a term called the God in the machine, right? There's a God in the machine. There's a machine called the economy, and God in it is the Fed. And in this function, it generally resolves an irresolvable plot situation. It's a surprise. It brings a happy ending or comedy, happy ending or comedies to a situation. The Fed is the Deus ex machina. They're trying to run this show. They're the God on the machine. But here's the thing. They have to get to a core PCE rate, but stable prices and maximum employment are the goal. So they're trying to deliver a 2-part soft landing by focusing on stable prices, lowering the inflation rate. But they have another mandate to keep maximum employment. So that's the soft landing part. They have 2-part mandate. Everybody's focusing on this at the moment. That's obviously because we had an inflation spike. But remind yourself that the congressionally imposed 1977 mandate for stable prices includes a second mandate for maximum employment. So since 1977, they have had to track these 2 statutory goals. This is the focus now, but when it goes away, this will still remain the focus. That is the bull case. They're not going to send us into that recession, they're not going to keep Fed funds rate and destroy the economy beyond maximum employment where they're going to keep us. That's the idea. Keep it in mind. The Fed is really the story here. The Fed is big. They run the economy. They stay on top of this. They have vigilant 8 meetings a year. They are not out of touch. Thank you for attending. That's my story for you on the economy and the leading indicators and the coincident indicators. I hope you liked it. It's a little different than what I normally do. If you want to get a hold of these slides, call us at 866-794-6065. Send us an email at strategycall@zackspro.com or get us and find us on the web at www.zackspro.com. We also have a LinkedIn page, Zacks Professional Services, and a Twitter feed at ZA2Tools. My best advice to you is to send us an email, strategycall@zackspro.com, or give us a call, 866-794-6065. That's it for me, folks.